Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
So welcome to the show. Today we have Yonah Weiss to talk about cost segregation and bonus depreciation. This is an amazing topic. It blew my mind when I first heard about it, and so glad that we have Yonah to share about all the tax advantages available in multifamily and commercial real estate. Welcome to the show, Yonah.
Thank you, Ryan. I appreciate you having me.
Awesome. Well, let's jump right in. So why don't you tell the listeners a little bit about yourself and Madison Specs?
Sure. So like Ryan said, Yonah Weiss, I'm the business director at Madison Specs, which is one of the largest cost segregation companies in the country. A little bit about me. I had a background in my professional career as a teacher for many years, about 15 years, until a point in time, I just decided I want to do something more. And, decided real estate was a great opportunity to grow wealth and to, I didn't really know what to expect. That's really the truth. And I found an incredible community in doing so. But in the process of, I got doing some fix and flips, I got my broker's license, was doing commercial mortgage brokering until a point where I found I needed something a little more because my background was in teaching and that was really my passion. And so I found this, this company, Madison, which is an incredible company, especially if you're in Texas, you know who they are, title, right? A lot of other services, cost segregation. It's a company that I feel at home at and a really amazing place to work. So, I got involved in the cost segregation department, more doing things like this, just teaching, just because I found this is a subject that most people don't know a lot about. And I was able to provide a lot of value by, studying it under our, experts, the accountants and the people who have been doing this for decades, and, trying to give over whatever they taught me to the world at large in a way that can be, palpable, because it's a complicated, taxes, people get turned off. They're like, don't talk to me about taxes, right? That's for my accountant. So I found a way to make it that it actually is fun to learn about, and, it's exciting. So happy to be here with you today, Ryan, so your audience can learn.
Awesome. Well, let's jump right in. So walk us through what cost segregation and bonus depreciation are.
Yeah, so let's take a step back and just understand first what depreciation is, because you really have to understand that in order to understand what cost segregation is, because cost segregation is like just a more accelerated form, or a more, it's like depreciation on steroids, basically, for lack of a better word. Depreciation, first and foremost, is a tax write-off based on the concept that property goes down in value as time goes on. And I say it's based on the concept because it's really hypothetical, as we'll see in many, many facets of depreciation. It's just theoretical. It's almost hypothetical. So the first thing that we have to understand is that the IRS allows you to take a tax write-off, meaning write off the entire value of a property that you purchase. So let's say you buy a property for $1 million. You now can write off that entire $1 million over a certain period of time. Okay. So the first thing that stands out is well, why would they do that? Maybe the property is only worth, $500,000, but I paid $1 million. So now I get to use that as a tax write-off. So that's one thing. The second thing is that you always have to wonder about is that this building's really old. Okay. I bought a building that was built in 1925. But the IRS is allowing you to take this depreciation deduction, which means that a building has a lifespan of 27 and a half years, or 39 years for commercial, when in fact that lifespan starts over every time a person buys that property. Okay, so it's very hypothetical in that sense. So again, depreciation is you're allowed to write off the value of a building over the 27 and a half year lifespan, if it's residential, multifamily, or a 39-year lifespan if it's commercial, okay? That's depreciation. And it's an income tax write-off. Again, you use this to deduct from your income tax. Cost segregation is the process of breaking down those costs, okay, into different categories. So segregating, right, the cost of the building into different categories. So let's, instead of everything on this 27.5-year schedule, meaning taking a little write-off every year for 27 years, I can identify or segregate things in the building that, you know, identify the cost, the value of those things that depreciate on a shorter life. So for example, personal property, okay, which includes cabinets, you know, furniture, fixtures, appliances, carpeting, right? All that kind of stuff that's not part of the structure of the building depreciates on a 5-year schedule, which means if I can identify through the process of cost segregation, using an engineer to identify what the cost, what the value of all those things are, I can now take that entire value as a tax write-off over 5 years instead of lumping it all together with the rest of the building over 27 years.
Awesome. Awesome. And then tell us about bonus depreciation.
So bonus depreciation is a law that came about in the recent tax reform. There was an existing law, but it was changed to become 100% bonus depreciation, which means you can take anything that depreciates less than 20 years, which includes everything that we identify in a cost segregation. And instead of taking it over a 5-year span, right, or a 15-year span or a 7-year span, different items, which we can talk about what those are in a second, you can now take it all in year number 1 as a tax write-off. So, you know, literally identify, you know, 20% of the building or 30% of the building as a faster depreciation category, then take that entire amount as a tax write-off in year number 1. That's called 100% bonus depreciation.
Awesome. And then, you know, just to kind of set the stage, what percentage usually of a building are you able to bonus depreciate? Typically like year 1, what percentage?
Yeah. So it depends a lot on the type of building, because there are many different, you know, types of building. Each building is going to have a different allocation. So for multifamily properties, for example, generally it's between about 20 and 35% is going to be reallocated to what's called either the personal property that depreciates on 5 years, or the land improvements, which depreciate on a 15-year schedule. So land improvements would include like landscaping, pavement, you have parking lot, okay? You have fencing, all kinds of all of that stuff depreciates on a much faster schedule. You can, you know, get that. So other properties would have different allocations, like a warehouse, for example, would have the least amount of any type of commercial property because there's very little in terms of furniture, fixtures, et cetera, in the building, usually about between a 5 and 10% reallocation. And then on the other end of the spectrum, you'll have things like, you know, assisted living facilities or skilled nursing facilities are a little bit higher than multifamily properties. And mobile home parks on the far end of the spectrum, or golf courses, which are entirely land improvements, okay? Which means there's almost no personal property there. There's almost no building. It's all land improvements. Like think about a golf course. It's all landscaping pretty much. So we're talking 70, 85, 80% of the actual property can be reallocated to those faster depreciation lives.
Awesome. Yeah, I appreciate you setting the stage. Can you walk us through, particularly for multifamily, you know, the 5, the 7 or 10 and 15-year buckets, what's entailed in each of those, just to give listeners a good understanding?
Absolutely. And again, the process, you know, requires an engineer to actually come to the property, identify what those things are, use the skills, you know, obviously the acumen of an engineer and the knowledge of the tax code to know what, you know, what are these categories. But you'll have personal property. Again, that's the 5-year category. Stuff like I mentioned, cabinets in a multifamily property, furniture, fixtures, special purpose lighting. So that would mean not actual structural lighting. Okay, structural electric and structural plumbing goes into the actual structure of the building, which is again that 27-year period. But you know, special purpose where you have, you know, even if you have LED lighting, okay, it's considered special purpose. Or you have like, you know, spotlights, or you'll have, certain types of, I don't know, an exit sign or things like that are actually just kind of accessories almost to the building. So those are all included. And then other things like carpeting, okay? Carpeting is not part of the structure, or vinyl flooring, even though it's, you think it's part of the building, it actually can be removed and therefore considered personal property.
Okay.
Yeah,
Right,
a lot of other things. 7-year property is usually like cable wiring and type systems, and that's usually more like an office buildings. Very few things fit into the 7-year category.
Okay.
10-year category also is very, very few things, and very rare type properties, like a vineyard, for example, depreciates on a 10-year schedule.
Okay.
But 15-year is really the second main category. So 5-year
Okay.
and 15-year is almost the bulk of everything in cost segregation. And that 15-year, again, includes called land improvements. So anything that's outside of the building, like your landscaping, your fencing, a swimming pool, a playground equipment, pavement is the biggest, and curbing. Okay, you have a parking lot, pavement, all that stuff depreciates on a 15-year schedule. And it's the job of the engineer to identify, what's the square footage, what's the value of each asset, okay? And certain types of pavement and curbing have different values than others, okay? If you're laying a parking lot, right, that asphalt has a different, per square footage value than, let's say, the curbing that you put in the sidewalks. Okay.
And then what about mechanicals, ACs, boilers, even roofs? Where do those fall?
So roof is a structural component. Okay, like the walls, like the floor, like the foundation. HVAC is usually also, if there's a main HVAC system or boiler system, they're also considered structural because they're necessary for the actual building. However, in most cases, there are, individual HVACs, okay, that are not part of like the main structure. So you'll have an individual unit, air conditioning unit in each unit or something like that. Those are actually considered on that 5-year property as well.
Okay. And the items that are structural, those are just depreciated straight line over the 27 and a half year.
On the 27 and a half, exactly. Which is why in most multifamily, like I said, 25 to 35% is in the faster category. The remaining amount is in the actual structural building component.
Okay, awesome. And then just, just for our listeners, what is the minimum size, let's say, of an apartment complex that you can order a cost segregation study on?
So you can really do it on anything, but in my rule of thumb is usually over $1 million purchase price. Because again, the actual basis, the amount that you can write off is based on the purchase price. Minimum in my book is $500,000. But anything over $1 million is like a no-brainer. Okay. Once you're at over $1 million, you see tremendous amounts, because obviously there's a fee involved in the process of hiring a company to come out and do this. It may be a few $1,000s or more, and to make sure that the tax benefits are going to be, obviously equal or greater than that. The bigger the property is, the more proportional, right, those numbers are.
Okay. And just, walk us through at a high level what those fees are, what the time is to, order that cost segregation study and so forth.
Sure. So I can only speak for our company, Madison Specs. We are the largest cost segregation company in the country, working in all 50 states. So it should give you a pretty idea. The fees are always going to be based on a scope of work involvement. Okay. So it's never going to be contingent on the actual tax savings. If a company is coming and saying they're contingent on the tax savings, okay, you're going to get $100,000 and we're going to take, 20% of that as our fee. That's a big no-no. Okay. It's actually looked down upon in the IRS. It's not explicitly illegal, but it's looked down upon because you're basically saying to the IRS, I'm going to say how much tax benefit they're going to get so that I can take a piece of it. You're no longer a third party doing that. So it's looked down upon. So again, the scope of work, usually between $4,000 and $6,000 is a typical apartment building. That's going to be our fees, generally speaking, as of the recording of this in 2020. And the process is very, very simple. Okay. It's not this whole complicated thing. Now, the one thing that people think about is, well, how come my accountant didn't tell me about this? And the main reason why a lot of times accountants are not proactive in this regard is because it requires a engineer or an engineering firm like ours to come and actually do the work. So the first thing we always do is run the numbers for free, no cost, no obligation, just to show you what the actual tax savings are going to look like if you were to go ahead and do that. So our projections are usually very conservative, and that's, you get that in a day or two, submitting some numbers to us. And at that point, it's very educational to see, well, hey, I'm going to spend $5,000. I'm going to get back, $500,000 of tax benefits. Sure. Right? It's a pretty no-brainer, right? Now, at that point, you'll engage, us or a company like ours to come and have an engineer walk the property, take pictures, measurements. We'll use other documentation to verify all the facts, the closing statement, appraisal, a survey of the property to make sure that everything is according to what we found. And then we'll create this report. Usually takes about 6 to 8 weeks. And that, in the end of the day, will produce a depreciation schedule that is broken down into these different categories, showing you what your tax write-off is going to be for the entire life of the asset.
And what type of people do you think this is a huge benefit for?
It's beneficial for anyone who needs, the extra tax deductions. Okay. So if you're someone that you already have, your whole tax situation worked out, you're not paying any taxes, then you're good to go. This is not for you. All right. For someone who is looking to grow their portfolio, someone who is looking that they need more cash flow, because in the end of the day, what this is doing is creating tax deductions, allowing you to keep more of the actual cash flow from the building. Okay. If you make $100,000 from your property this year and you have $100,000 of depreciation deductions through cost segregation, that means you're paying zero tax dollars of the money that's yours. Okay. So again, this is money, income, you're keeping the entire amount. Now you can go ahead and use that to improve the property, use that to reinvest. The possibilities are endless. If you're only going to hold one property, okay, buy one property, it may make sense to actually strategize and tax plan that, you're not taking more deductions up front. You're actually going to spread it out more equally. May not be for you. But again, the people that are going to benefit the most are, again, those people who are, need the tax deductions. A lot of times groups, syndications are coming together doing this because it's going to also benefit the investors as well.
Awesome. Yeah, that's really helpful. And then can you just walk us through what a real estate professional is? Because that's a key component of being able to leverage the benefits of bonus depreciation.
Sure, 100%. And that's a great point. Kind of segue from the previous question, who's going to benefit the most? Sure, and really the answer to that is, the real estate professional. And so this is an IRS definition of, not just a coined name, but actually a definition and a box that you check on your tax return if you fit this status, which is, there's 2 requirements, okay? And the first one, it's either you or your spouse, okay? So this is something that either one of you can have this status, and together you can reap the benefits, okay? You have to have spending more than 50%, 50% of your time, more than half of your time in a real estate trade and profession, okay? Materially involved. So if you own properties and you're involved in the management of those properties, asset management, the property management, you're involved in brokering, you're involved in doing any kind of rehab or construction, you're involved in any type of, like I said, brokering, you have those hours, right? You're spending your time in real estate trade and profession. Even in acquiring, right? If you're looking at properties to acquire, you're traveling to properties to acquire, and you actually do acquire something, you can't just, then just be traveling all the time and looking at stuff and never buy anything. You actually have to own property to get the status. You can now use these deductions to offset not only income produced from the property, but also ordinary income, okay? Which means like this, depreciation is a passive deduction, okay? It's a passive deduction that can be used to offset income from passive income. Okay, passive income includes real estate, your properties. So if you have, properties, you're producing income from that, that's called passive income. Depreciation and cost segregation, which again is like a lot of depreciation, can be used to offset that income. However, beyond the income from your passive investments, depreciation can no longer be used to offset other income unless you're a real estate professional. Okay. If you are a real estate professional, you get this magic status, you can now use those deductions to offset your income also from any other source or your spouse's. Okay. So just to illustrate that, let's say, your spouse, you or your spouse is a high income earner. Okay. You're earning $1 million a year. That's great. However, you're going to be taxed at a very high tax rate. If you were to buy property, multifamily, whatever, commercial property, create, the bonus depreciation deductions to get a huge amount of deductions in the tax year, literally more deductions than you have income from the property. So the first deductions, the depreciation offset the income from the property. Let's say you made it, $100,000 from the property, and you created $1 million of deductions. Okay, 100,000 is going to be used to offset the income from the property. The other $900,000 is going to create a loss. And that loss, if you're a real estate professional, can now be spilled over to offset your, your W-2 income, your other income from any other source.
And even stock capital gains and so forth.
Exactly.
Dividends.
Yes.
Okay.
100%.
All sources of income. That's great. That's awesome.
Yeah.
Walk us through, so that's the upfront benefits. Walk us through
Right.
recapture and what that means, what happens.
Sure, absolutely. So recapture tax, is a tax that happens on the sale of a property. When you sell real estate, not only are you hit with a capital gains tax if you sold the property at a gain, at a profit, you're also taxed with something called depreciation recapture tax, which is a 25% tax on the amount of depreciation that you took. Okay, so now what's going to happen if I take this huge amount of depreciation up front? Okay, and then 5 years later, I go ahead and sell the property, or 1 year later, I go ahead and sell the property. So first of all, it's not a good idea, usually in my opinion, to do the cost segregation if you're going to be holding a property for under 2 years. And I'll illustrate the reason for that, why. But before I get to that, I want to mention there's one strategy that helps to defer not only capital gains tax, but also depreciation recapture tax, and that's called a 1031 exchange. If you don't know what that is, you can Google that. I'm sure Ryan will have another episode on
that's
that
coming
at a certain point. What the 1031 exchange is and how that benefits you to help grow wealth by deferring capital gains tax on a sale, deferring the depreciation recapture tax on the sale. So usually, right, your income is taxed at a high rate, especially if you own, large properties, right? You're getting income from a large, on a large level, your your tax rate is usually probably going to be 39, 43%, tax rate, especially if it's federal and state combined. When you look at the spread between what you would have paid in tax today versus what I would have to pay 5 years from now when I sell the property at a 25%, it's usually, enough of a spread that it makes sense to use that money. And I'm going to have a net gain on the amount of taxes that I saved over that period of time. But beyond that, even if you don't even look at that and you have something called the time value of money, it's beyond what the spread of that is. It's also it's my money in the first place, which means if the IRS says, hey, guess what? You don't have to pay tax right now. You have the option to pay tax in 5 years from now. So it's saying, I would rather, right? It's like IRS is coming to you and saying, guess what? You can have a gift of not having to pay the tax right now. Would you like to pay the tax now, or do you want to pay it later? So, to me, it's finance 101, okay? It's the time value of money, which means having money now versus having money 5 years from now. Obviously, you want to have the money now because you can use that money. You can get interest on that money. You can grow that money through more investing, etc. But it gets better because there's something called partial asset disposition, which is a strategy that most people use on the sale of a property, especially if you did cost segregation. That strategy says, and this is a tax form that's filled out upon the sale of a property, which says that after, just take a step back. We learned that we are, through cost segregation study, identifying property that depreciates on a 5-year schedule, all the furniture, all the fixtures. So we're saying, hey, this value of this, washing machines, right, or the 100 washing machines that I have in the property are worth $50,000. Okay, pretty cheap, but let's just give that example. $50,000 is now, after 5 years, I've taken that depreciation already. I've said that this has no more tax value to it. After 5 years, I can now say this literally has no value to it. I no longer have to pay depreciation recapture tax on that amount because it's already been depreciated. It already has no longer value. Therefore, upon the sale of the property, if you do this partial asset disposition, allocate values to all those things that have already been depreciated, you are only going to pay the depreciation recapture tax on the actual structural components of the building or the other things that are on a longer schedule. Meaning, not only are you getting the tax write-off in those first 5 years, but you're not even going to have to pay the recapture on that.
Okay. Wow.
Yeah.
That's
a huge benefit that, but even if you don't do that, okay, it's still obviously, for the other reasons I mentioned before, the spread of that, the time value of money are usually going to be more beneficial to go ahead and do it.
Absolutely. So, just to recap that. So if you're in a high tax bracket, the highest bracket in the US, 37%, and you offset your income through bonus depreciation at recapture, in the worst case, you're going to pay 25%. So there's a tax arb right there. Is that correct?
Right. Exactly. The arbitrage, exactly. Arbitrage is going to be beneficial there. Exactly.
Okay. As well as the time value money, as well as you said the partial asset disposition, which you may be able to not have to pay the taxes, and then the potential to go into 1031. So there's a lot of optionality, it sounds like.
A lot of options, exactly.
That's awesome. So when and how should owners perform a cost segregation study?
So a lot of it depends on when is going to be the most beneficial, meaning when do you need those deductions? Sometimes in the first year of ownership, you may not need that. Sometimes in the first year of ownership, there may be no income from the property. It may be operating at a loss already because major renovations, because maybe you bought it at the end of the year, there's not enough income. It's always important to strategize and understand when is this going to be beneficial. And that's part of the reason why we provide this upfront estimate to show you what it's going to look like if you're doing the cost segregation, this year versus next year versus if you're not doing it all. And you can see what, when would it make most sense to do it? A lot of people, tend to do it right away upon acquisition. Okay. And people will even reach out to me when they have a property under contract so they can run the numbers and see what the potential benefits are going to be when I go ahead and do this during the first year, during the first 5 years. What's going to be the cash flow? What's going to be the real cash flow versus just the net operating income? The real cash flow is going to be after tax benefit. So people will reach out to me at that point. Like I said, get it done right away, get it done in the first year, second year. Again, that's a question that you're going to have to have.
Okay. And then what about rehab? So let's say you buy a property and, typically there's going to be a value add component. Can you roll that in after the fact? And what's the timing of that?
Yes. Excellent question. Because there's another component, which is if you're doing rehab, you're doing capital expenditures on the property, whatever money that you spend on the property to, rehab it or to, add value to the property, that is going to be added to your basis, meaning that amount of money is going to have to be depreciated as well. So that's something that you have to, obviously you can update that. You can get a second cost segregation study, kind of like a supplemental study to the original cost segregation when you're doing upgrades. And
is that typically included in the cost segregation study in terms of the fee? Or is that
if upfront, that's part of the plan, obviously the business plan usually is discussed beforehand. Is this something you're going to be doing? You want to be spending that. Not everyone has this, major value add, but when that is discussed, that's usually part of the fee.
Okay, great. No, that sounds awesome. Well, fantastic. That you walked us through some really in-depth concepts, very quickly. So really appreciate that. So, one thing that I wanted to just get to, kind of switching gears, and we'll also have a presentation that Yonah's team had put together associated with this video that walks you through, slide by slide, the concepts that he discussed. But just going into more personal levels, we like to do on the show. you're in Israel, so you're not in the U.S., right? So just walk us through how you run your business successfully out of another country.
So it's pretty amazing. And I'm just getting a notification on my computer right now that like something's happening, and it might do an update like forcefully in the next couple of minutes before I have a chance to finish this sentence. But I work for a very large company. Okay. And I think it's the dream of a lot of entrepreneurs to kind of work remotely. And that's really an amazing part of the experience I have, is that I can work for a company doing business development, doing seminars like this totally remotely. Whereas the actual work, the engineers, the base of the company is obviously in the United States, is doing that work on the ground. And most of my conversations are on the phone, on the email. And I think, that's part of the benefit of this modern technology today, in this day and age, that we can really be anywhere in the world and still be able to work. Obviously the hours are different, right?
What time is it there now?
So it's about 7:00 at night right now.
Okay.
But, it's kind of just a scheduling thing. These my working hours are 7 hours different than what they would be on the East Coast. So it's a give and take.
Got it. No, that's great. And you're one of the more recognizable faces out there in the multifamily space. So just walk us through your Orthodox faith and what that means to you, and maybe share some of the daily rituals and so forth that happen, especially there in Israel.
Yeah.
What I'll do is I'll ask that question again.
You can edit that.
Yeah, I'll edit it. Yeah, perfect. So we'll like nothing ever happened.
I'm so sorry. It's so crazy. It's part of the, I guess part of the process. I don't know.
No, it's fine. Don't worry about it at all. You've done a great job. So really appreciate it. So Yonah, would you walk us through a little bit about your faith and the beliefs and just the daily rituals that you go through in Israel?
Yeah, I mean, really, it's anywhere. Being Jewish is something that is, very special. It's an old, ancient religion, but with, very modern roots as well. Obviously, the Jewish people have done probably a tremendous amount for the modern world, as much as they have for the ancient world. But it's more of a godly kind of presence, omnipresence. Consciousness, literally going through the day. So praying 3 times a day, which can be up to an hour, taking out time out of your day, meditation, that kind of thing. But really walking with God, like everywhere, seeing presence of the Almighty, the Creator, everywhere you go, in every action that you have, everything we eat. Before we eat, we make a blessing. We recognize God before, little tiny things that throughout the day might seem insignificant to a lot of people are considered very significant in our kind of daily lives. And so in Jerusalem, where I live, it's actually intensified by, crazy amount, because this is just like the center of the Jewish world. And, being around people who are extremely brilliant minds, and many people who are kind of like extremely righteous as well in terms of their refinement of character, and just presence of mind. It's incredible.
That's great. Well, appreciate your time today, Yonah. This was great. You walked us through some really amazing concepts in a very short period of time, very succinctly. So listeners are going to greatly appreciate that. Again, there'll be a presentation. And Yonah, how can listeners get in touch with you?
Best way to find me is on LinkedIn.
Okay.
That's where I spend a lot of time, but you can reach me at yweiss@madisonspecs.com, which is our company. And definitely help. I hope you can, if I can help in any way, happy to.
Yonah, thanks again for being with us today. Really appreciate it, and look forward to posting this video for everyone to enjoy.
Okay, thank you, Ryan. I appreciate you also.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.